And JP, you want to introduce the next panel?
Next panel includes Greg BAER, the president.
I think you're not on.
Greg BAER, the president and CEO of the Bank Policy Institute, previously president of the Clearinghouse Association and executive VP and general counsel of Clearinghouse Payments Company. And also on the panel is Gary GORTON, professor emeritus of Yale School of Management, Elizabeth McCall, who's staying on, and Alex Pollock, the senior fellow at Mises Institute. So thank you all for joining, and I'll turn it over to Tom to open up the dialogue.
So let me start with Alex. Alex, are you there? You're there, right?
I'm here.
Okay.
I'm here by Zoom.
Yes, Alex and I have known each other 150 years also, so I very much appreciate your being on, Alex, and sharing your views with us. I know you've written about it. I know Gary's written about it, so I want to start with this question, and maybe you and Gary can both speak to it, and that is the subject we raised with Elizabeth, and that is, do we miss so many signs about a financial panic? Are we not prepared for financial panics? And if that's so, why is that?
Thank you, Tom, for the question, and thanks very much for having me, Tom and JP, on this panel. I think first of all, it's the problem of not picking up on or not acting in time on the panics is not a problem of intelligence. We got lots of very high intelligence, thousands and thousands of very smart people all working on these problems, both in the private actors and in the government. And in fact, part of the problem arises from the interaction and the self-reference and recursiveness of having thousands of extremely smart people all strategizing and working on their expectations, and each other's expectations, and the moving of ideas into reality, and then ideas changing. So I think it's a problem of knowledge, basically, a problem of how you can know about the behavior of extremely complex recursive systems like financial markets. And it's a problem of knowing about this very strange kind of reality that financial markets are. So if I think back to the misspent days of my youth studying philosophy, I could even say we have a fundamental problem of epistemology and ontology, but I won't press that any further. Financial markets, as Elizabeth said, it's an art, not a science. So we should ask ourselves, well, why isn't it a science? What about these markets makes it so that they can't be turned into a science the way, say, econometrics once hoped to do it? And it's because of this odd nature. These are interactions among lots of smart people, and the result of the interaction is fundamental uncertainty. That is to say, Knightian uncertainty, where not only is the future unknown, but we can't even know the odds of future outcomes, and indeed the future is unknowable because it's this non-physical, non-determinative, non-mathematical reality which arises from human action. All of the actors, governments and private actors, all together influencing each other. So I think you have to begin by conceiving of the financial system correctly. It is what I call an interactivity, a system which is recursive, reflexivity rich, to use that term, expectational, extremely complex, self-referential. We know that self-reference always gives rise to paradoxes and surprises. And so we have fundamental questions like, well, what risks are there? And it's just not a matter of seeing the risks in this complex uncertain system, but of imagining them. Tim Geithner nicely said, and about, I don't know, 2013 or 14 or so, the problem was a lack of imagination. You couldn't imagine what all would happen and how bad it would be. Always involved are prices. How much can prices fall, especially the prices, which are the price of collateral used to create financial claims. And the general answer is that prices can fall more than you think, and more than your model thinks, and more than your worst case put in. How big can losses get? The general rule is losses can get bigger than you thought they could. You knew there was this risk of loss, but how big could it be? This would be a good case, Tom, for your cyber risk. How bad? Okay, cyber risk is a risk. We all know it. We all talk about it. But how big could the cost be? That's what we have to imagine. And in general, as an old banker told me years ago, risk is the price you never thought you'd have to pay, and you never thought you'd have to pay it because you couldn't imagine how much the prices would fall and how big the losses would get. Just a final note on this issue. After the savings and loan crisis, a great crisis of the day in the 1990s, as very interestingly discussed in a publication by Arnold Kling, he called Not What They Had in Mind. The regulators carefully studied the savings and loan collapse of the 1980s. Of course, there were other problems in the 80s as well. They came up with lessons, which they then implemented. And the lessons were you needed more securitization, you needed risk-based capital, and you needed mark-to-market, and securitization and risk-based capital and marking to market either helped inflate the bubble or made the crisis worse when it came. So you can get a buildup of systemic risk from applying the lessons of the last systemic risk. That's part of recursiveness. That's it. Thanks.
Yeah, Alex, that reminds me of what happened in London when the bubonic plague hit in the 1600s. The government decided that all of the cats and dogs in London should be annihilated, which of course increased the rat population, which was the cause of the plague. So, Gary, let me say it's terrific to have you here. I have liberally cited your books on this subject over and over again. Add your 2 cents to this question about financial crisis and why we never see them coming. You got a mic right there.
Okay.
You want to grab the mic because we're on Zoom also it's got to be turned on here. There you go.
I think the problem is an intellectual failure. People can't distinguish between risk and systemic risk. And so they think every risk is a systemic risk and every risk should be monitored and regulated and so on. But that's not what we're concerned about. So the 2007-2008 crisis cost $30 trillion. The previous 10 years worth of bank resolutions in the United States cost us $30 billion. And that's the distinction you want to have in mind in this conversation. So what exactly is the problem? Well, one problem is that in 2007, 2008, you didn't see the run. You didn't see the bank run because it was with a different product than demand deposits, and you would only see it if you were on a trading floor. And a lot of the people on trading floors didn't know what they were seeing. And since everybody outside the trading floor didn't know what was going on, they blamed the effects, and they thought the effects were the causes. So they got all hot and bothered about various things, which are really just effects of the run. Now, why? You know, we could have known about that, but that doesn't mean anybody's going to do anything about it. So if you look at a financial stability report, say the Fed's financial stability report, you're going to see chapters that just have nothing to do with crises, you know, stock market stuff. I mean, it's just ridiculous. And the poor people who have to write these reports, of course, don't have anything to say. And so they can't say, well, we looked for systemic risk this week and we didn't find any. They can't say that. But there are interesting clues out there because runs are all on the liability side and it's all about debt. For example, variable denomination floating rate debt. That's a product which is not huge yet, may never become huge, but it's outside the radar of everybody. It's not no data vendor collects data on this, so you have no way of knowing what's going on. And then even if you knew, it's not clear you would understand what's a systemic risk and what's not a systemic risk.
Greg, let me turn to you. You have, I think, with BPI, become a terrific advocate and a very vocal advocate for a lot of issues that normally trade associations might not have become as vocal about. And it seems to me a lot of what you're saying is that we're focused on, as I said before with Elizabeth, we're focused on the trees and missing the forest, and the trees are miscalculated, or in the stress test, the assumptions are unknown and hidden. Talk a little bit about that, and is that sort of giving us a misfocus in regulation that's really hurting rather than helping oversight?
Sure, and thanks for being here. I mean, I will say with the stress test and some of the earlier remarks just made me think of this. There's one great virtue of the Federal Reserve's stress test. It's an extraordinary, and one would say perhaps too large a stress. It's unemployment goes to 10%, stock market down 50%, housing prices down 30%. The things that happen in spreads in the global market shock are otherworldly and I think probably internally inconsistent. But one virtue of the Fed stress test is they don't try to predict what caused this. What they basically say is something bad's going to happen. And when bad things happen, banks tend to lose money the same old ways, which is because unemployment goes up, GDP goes down, and housing prices go down. And so I think that's a certain implicit humility in the stress test that I actually kind of admire. More broadly, though, I do think, and maybe we'll talk more about macroprudential, that should be more of a guide in the sense of not trying to predict what the next crisis is going to be, and rather ensuring that banks have sufficient capital, liquidity, whatever, to survive it. I don't think anybody disputes coming out of the global financial crisis that, actually, by the way, pet peeve, it's the global financial crisis. It's not the great financial crisis. Starting about a year ago, people started calling it the great financial crisis. I actually did a little blog on this. The reason it was a global financial crisis and not a great financial crisis, first, it was global, and second, it wasn't that great. So please stop. If you're doing that, just stop. There's a great recession that came after the global financial crisis, but the global matters. That's like why we talk about it, because it was global. Sorry, I've now completely distracted myself. So coming out of the global financial crisis, clearly banks needed to have more capital. It needed to be real capital, so common equity tier 1 and not sort of all kinds of different instruments. It needed to cover off-balance sheet risk as well as on-balance sheet risks. All of that was sort of unarguable and is now sort of completely forgotten that we actually did that. There was also a notion that the securities business shouldn't be funded through short-term wholesale funding to the extent that it was. And that, I think, has been largely rectified. So those are sort of the basic important things that happened. But we did not have a global financial crisis because of vendor management or because IT systems weren't sufficiently up to date or any number of operational issues that are now the primary focus of our supervisory regime. And in part because, to their credit, I mean, we now have, quantitative, tough standards for capital liquidity, all of which is sort of run out of Washington. But, you still have examiners out there, and what are they going to do if they're not calculating the capital ratios? Well, they're going to look at, well, I just heard recently we've now moved from vendor management to third-party vendor management now to fourth-party vendor management. So you're managing your vendor's vendor to ensure that they are doing things the right way, all with no real losses in this area. And I think that's where we sort of lost focus. It's now trees, not forest. And I hope we talk a little bit about SVB, but I think SVB was actually an example of that, not a counterexample.
Thank you. Greg, the concept of prudential regulation is reserved for banks, despite the fact that they are only a minority of the financial services market. You've been thinking about macroprudential supervision and the assumption that regulators should be able to spot crises ahead of time. If you could please expand and share your thoughts on that.
Sure. I like to keep score, like in life, and I think macro Pru is either 0 for 4 or 0 for 5, depending on how you think about it. So global financial crisis, leaving aside mortgages, the reason it was a global financial crisis was because how things were funded. No one spotted that, 0 for 1. 15 years ago, 10 years ago, the regulators decided we were going to have a leveraged lending crisis in banks and basically browbeat banks out of making leveraged loans. That is, loans to mid-sized leveraged companies. They issued guidance. When the banks treated that as guidance, they told them this isn't guidance, you have to do it. They did FAQs. They set a ratio, 6% debt to EBITDA, basically enforced that as a rule. The GAO actually found that it was a rule and it was illegally adopted under the Congressional Review Act. They continued to apply it. They continue to apply it to this day. It's remarkable to hear now people in the official sector decrying the rise of private credit when they were and maybe even the proximate cause of that, because they bullied the banks out and a lot of regional banks and small banks out of making those loans through use of these formulas. By the way, Fed study shows when they pushed the banks out, that just rose private credit, and there's been no crisis. So call that 0 for 2. 5, 7 years ago, impending crisis in commercial real estate. I think everybody, even at the time, the real analysts outside the regulatory community recognized that most of those problems were in CMBS office towers in large cities that were not on the books of regional banks, but it was the regional banks who got the word from their examiners, you got to increase that. So call that 0 for 3, 0 for 4. Climate, real push 5 years ago. You need to, for financial reasons, let's leave aside climate as climate, you need to be making fewer loans to brown energy companies, more loans to green energy companies, or else you're going to have a financial problem. I think by any measure, if you track the stocks, the bonds, whatever, that would have been a disastrous move if banks had actually done that as a financial management matter. Again, leaving aside, the good of the planet. And then the most startling one was, SVB and the upset among regional banks, which was caused by the Federal Reserve raising interest rates 500 basis points over a period of time. And if you'd think, oh my God, if ever there was a macro Pru problem that the regulators would have spotted, it would have been one that they created, and the buildup of interest rate risk, so they missed that. So we've had sort of type 1 and type 2 errors. They spot macroprudential problems where they don't exist, and they miss macroprudential problems where they do exist. And I'm sorry for them, but the question is, should we keep trying to do this? Or we should be more like the Fed stress test and say, you know what, we're going to get out of the prediction business. We're just going to make sure that banks are adequately capitalized and adequately liquid and can survive whatever may come to them.
Elizabeth, let me turn back to you, and I want to ask a question. And this is before we get to the Fed, because I know Alex is very anxious to talk about the Fed. But I want to ask one general question to both you, Elizabeth, Alex, and Gary, and that is, if you had a free hand to design a financial regulatory system in the United States, what would it look like? Because I think we can all agree that if we had to design the system today, it wouldn't look like what it looks like today. When I was ending my career as a lawyer, I remember representing a nationwide home mortgage bank and talking to the general counsel about the fact that that bank had to satisfy the requirements of about 160 regulators every day before it turned on the lights. So there's maybe 7 or 8, 9 federal regulators. You include the SEC, the Federal Housing Finance Agency, and then you've got maybe 2 or 3 regulators in every state: banking, securities, consumer protection. And that strikes me as a system that is doomed to fail just by its redundancy and inefficiency. So assuming that we want to recreate the system and we have a free hand today, what does it look like? You want to start, Elizabeth?
We have the advantage of addressing that question at a moment when there's just an enormous amount of acceleration on the technological side. So I think you can't ignore that fact. And if you had a free hand in designing it, you'd need to put technology right at the core, right at the center of whatever that supervisory strategy would be. I'd do an enormous investment in being able to parse the massive amount of data that is already there in a way that allowed you to understand far better where there is peripheral risk that is developing. And I'd make it a far more simplified structure, because I think if there's anything we've learned over these decades, it's that the gaps between the various supervisors allow for financial crises to emerge. No one spotted the subprime crisis or predicted it. That's certainly a correct statement. But there was plenty of evidence around that in the securitizations, there was an enormous amount of credit being delivered to entities that would not be money good, to individuals that would not be money good. And there was just no assessment taking place for that, because there wasn't a structure to allow that component of the market to be looked at. I remember when I was banking superintendent issuing a letter to Wall Street, which was far beyond my regulatory perimeter, but as a former investment banker, it was blindingly obvious that these prospectuses touted the types of loans that would not be repaid, that were at the heart of some of the supervision program that we had in New York and the mortgage companies. So we could see that there was fraud taking place and that there were loans that would not be paid ultimately. And we wrote that letter to Wall Street about the securitizations to conduct further due diligence and to make that more transparent so that the markets could appropriately assess it. So that, I think that simplifying the structure, eliminating gaps, and having at its heart, harnessing especially artificial intelligence to improve the macro view, I think would be extremely useful.
Alex?
I would say, first of all, whatever we think it's not going to happen, so we can say whatever we want here. I would think about a financial system, definitely, that had a lender of last resort in it as a central bank. That seems to me a good lesson of history, that they're very handy more frequently than we might like. I would not have a central bank, however, whose mandate is to try to manage all parts of the economy. Greg pointed out the interest rate factor in the SVB failure. I would say it's not the raising of the rates, it was the long time suppressing of the rates that created the SVB failure. I call that the Fed as Pied Piper, and following the Pied Piper was not only Silicon Valley Bank, but lots of banks, and that's why the Silicon Valley Bank time there actually was a systemic problem attested to by all the regulators. I think we'd, in a system, have two other points. In a system I would try to create would be focused on the issue, if up of the financial system by the government, how much capital would it take? That is a question I would focus on a lot. How much capital would a bank have, and maybe other aspects of it, like its liquidity, if there were no government support and the bank had to convince people to take its liabilities on its own? What would it look like? I'd focus on that question. And finally, the toughest question, because we mentioned Financial Stability Oversight Council, FSOC. I think FSOC has a fundamental problem that it cannot overcome, and that is it's part of the Treasury Department. That is to say, it reports to one of the principal political officers of the government, the Secretary of the Treasury. Therefore, what can it say about a particularly really important kind of risk, like the suppression of interest rates? What can you say about risks that are being created by the government itself? If you're FSOC, the answer is you can't talk about it. You get yourself in trouble with your bosses, and you don't want to do that. So if it were possible, one of the elements, and this is my last point, of a financial system I would try to create would be a truly independent systemic risk advisor that had no regulatory power whatsoever, no ability to act, only an ability to think and comment, I don't know that it would be successful, but I think it would be worth a try.
Gary?
I don't think the regulators are doing such a bad job. I mean, it's easy to kick them when they're down, and it's kind of cheap to criticize them all the time. But the reality is they're up against a pretty complicated reality, and I don't see that as a big problem. Sure, we'd like them to be, omniscient, and we'd like them to be all geniuses and figure out where all the risk is, but that's not going to happen. So I don't think there's any way to get around the fact that regulators have a hard job and they don't always get it right. I think the more important question is, what would I do? Well, I would subject everybody at the Fed to a series of lectures, reflecting my background, to just explain to them what the hell they're doing. I mean, these are people who they don't get what a financial crisis is, but worse, they don't get what the financial crisis is. So you can't even talk to them because they think they know everything. Let me just mention about SVB Bank and Signature and Silvergate. We all knew that these were very special banks, and we knew they were experimenting with different business models. And we also knew, it's in Fed data, what the fraction of uninsured deposits was. So that wasn't a surprise, really. The surprise was that there was, that Powell and Yellen panicked and, insured all the debt because they didn't know what the hell was going on. The markets knew what was going on. Remember, there's some stock by some other West Coast banks that went down, and then the next day they went back up. So I don't think there's a lot of lessons there. I mean, the thing is that if you don't let banks innovate, they're going to just become stale institutions. And so these guys are innovating.
They're kind of related, Gary, and actually for everyone. Are the regulators measuring the right things?
No. I mean, if they were serious about systemic risk, they would say, oh, it has to do with short-term debt. Short-term debt is runnable. So we should go out and find the short-term debt. And if they did that, I think they'd find some interesting things. I mean, the other stuff, I think they do a reasonable job on measuring.
Yeah, I'm going to talk a little bit about Silicon Valley Bank. A lot of people don't know when, as part of the Fed report, which I violently disagree with, it wasn't the Fed report, it was the BAER report. It was not on behalf of the Fed. They actually released a lot of the exams. They released the roll-up exams. They released the exams, at least on interest rate risk and liquidity risk. Well, actually, that's all they released. But you could read the exams. I'm shocked at how few people have actually read the exams. And when you read the exams, and we had a wonderful note published by two of our folks, two of our senior fellows, Pat Parkinson, former head of supervision at the Fed, Jeremy Newell, also Fed alum. And what you see is that first they did not lack for examiners. They had a couple of dozen examiners. And they issued tons of MRAs on IT and corporate governance and vendor management. And those were the MRAs and MRIAs. And then sort of belatedly in came some on interest rate risk and liquidity, but proportionately small. And even then, those were not about you're taking too much interest rate risk, which was obvious because they actually disclosed, I read that too, in November 2022, that they were out of compliance not only with their own metrics, but way off market. But nobody said take less risk. They said establish more processes, revisit your limits, have another committee. And so it's just an extraordinary example of how misfocused the examination regime has become. I'd also notice it's fascinating. Frustrating. They did not release all of the exams on vendor management and governance and all those other things. So if you think of this as a wheat chaff exercise, they released the wheat exams, but they suppressed the chaff exams. And of course, there's no valid reason why you can't see what the vendor management exam at failed Silicon Valley Bank said. And someday maybe we'll get to see it. But I do think the lesson there is that we've lost focus. We'd be much better off with a smaller examination force, well-trained, and focused on material risk, not immaterial risk. And on that, since there's been talk of cyber, I had to call up actually a note that I wrote with my colleague earlier this year. On cyber risk, we did a survey of chief information security officers last year. They revealed that they spend 30 to 50% of their time on compliance and examiner management. Their teams spend 70% of their time on those functions. They reported on average over 100 requests for information leading up to an average exam, with anywhere from 75 to 100 supplemental requests during the exam. And 25% of examination requests duplicate requests from the other agencies. If you don't know, this includes not just the Fed and the OCC and the FDIC, but in the last administration, the CFPB began doing cyber exams on the theory that if there's a cyber attack, that might hurt consumers. Now, of course, the people conducting these exams are not veterans of the NSA. They're not from Caltech. They are folks who, and I feel for them, don't really understand so much how this works and are facing a bank that, in our case of our membership, may have anywhere from hundreds to thousands of cybersecurity professionals doing this. And so what do you do if you are in that place? Well, you ask to see the procedures, and you make sure that all the procedures are being followed. But I think it is almost inarguable that the greatest obstacle to banks defending themselves against cyber attack right now is the examination force. Now, I say that with two caveats. First, for smaller banks, I don't know. I think it's quite possible an examiner walking into a community bank could say, hey, you don't have any software here. So totally allow that. And second, and we'll talk about it, but there have been a lot of efforts between the government and the banks, the largest banks, around securing the payment system. Those are terrific. They've involved the Treasury Department and the Federal Reserve. They are incredibly commendable, but they have in no way involved the examination force that is out there doing what I just described.
Meg, we'll get to you one second. Just let me take a moderator's privilege here, because the point about SVB is one that has made me grind my teeth at night, because between Bob Hartheimer, myself, and Bill Isaac, between 1981 and 1984, we authorized the closing of 2,000 financial institutions. There's only been 4,000 closed since the Great Depression. We authorized closing half of them. And in my case, with 1,500 savings and loans, every single one of them was interest rate risk. Every single one of them, right? Because they got sideswiped by Reg Q, the rising interest rates in the Carter administration, and then it was, lights out. I just can't imagine, because I did read all those exam reports, I cannot imagine how a regulator, given how that interest rate risk problem was seared in my memory, how a regulator could sit there for 2 years and not say, there's a big problem here with interest rate risk. Put aside the management, which, bungled whatever it bungled. The regulators should have been there. The Fed should have been there saying, because the Fed was creating the interest rate risk by keeping rates artificially low. But, how could that happen? I mean, I just don't understand how that could happen. It's really shocking to me. But go ahead, Meg.
So I just wanted to expand a little bit on what you said and what Greg said. Remember, the substantive interest rate risk MRA in SVB was November 22. And that's super late. And kind of having been in, been in the bridge bank, they were overwhelmed with the chaff, right? Now, they didn't have a CRO. They missed interest rate risk. Management wears some of it as well. But one key thing, Greg, I wanted to add to what you said is that the Fed's OIG report disagrees strongly with the BAER report. But nobody in the media or academia has picked that up because it's in polite Fed speech. It doesn't say, we disagree with the BAER report. It just says, here's our diagnosis of the situation, 1, 2, 3, 4, 5. And when you put that up against what the BAER report says, and I also think of the BAER report as actually mostly driven by the senior supervisory staff, right? So we call it the BAER report. It's not a Fed report, but really it was the senior supervisory staff. And if you take the OIG report, and I just really urge the academics in this room to think about this, put it up against that other report, they're saying opposite things. And yet nobody's noticed because it doesn't have the fundamental word I disagree with. So I hope that somebody will take that up as an academic research, particularly in light of the fact that all of the things that were said to be done about reform of supervision in the OIG report, we haven't seen any public sense that any of them have happened.
Let me turn back to Alex on the Fed, because I know you've written a number of articles on, I guess, grading the Fed on a number of things, including monetary policy, the fact that it's losing money and the implications there, and its role in seeing financial crisis. Why don't you give us your elevator pitch in terms of what you're seeing and what you're concluding about the role of the Fed? Because one of the things I learned when I was researching my books is there's an awful lot of economists who would argue that from an economic point of view, it's questionable whether the Fed is doing more damage than good. I don't necessarily agree with that, but I know there's a lot of economists out there who carry that view.
Thanks, Tom. It makes me think of a great hearing in the Senate some years ago when former Senator Jim Bunning said to Fed Chairman Bernanke, I paraphrase, "How can you regulate systemic risk when you are the systemic risk?" And I think that has a lot of truth. It's not the whole truth, but it has a lot of truth. The actions of a money printing central bank, of a paper money printing central bank, can have tremendous systemic risk implications, as we saw, as just mentioned, with the suppression of interest rates, so that a bank like Silicon Valley Bank, basically, Tom, to your point, just made itself into a very big S&L. Its long-term fixed rate assets were not treasury bonds, as is often said. They were mortgages. Same with First Republic. It was just a big, in balance sheet structure, a big S&L. And interestingly, the Fed itself made itself into a big S&L with $2.5 trillion of 30-year mortgages funded short, not in liquidity purposes, but in interest rate purposes, funded overnight. Well, that was amazing. My own view is that the central bank in this or any country should own zero mortgages, not $2 trillion of mortgages. If you look at the interest rate risk profile of the Fed, at the beginning of 2023, a fundamental, naked, unhedged interest rate position of over $5 trillion of long-term, very long-term fixed rate assets funded in interest rate terms overnight. And if you do that and the market moves against you by 300 basis points, which partially is your own action, you suffer 300 basis points times $5 trillion of losses, which the Fed did. That raises a lot of interesting questions. The Fed has been shrinking. Its position, near as I can make it out, is still about $4 trillion of long-term fixed rate assets funded overnight. That's a terrible example, they said. And I think it raises fundamental issues of governance. To take that kind of risk and lose that kind of money, and whose money is being lost? It's taxpayer money. The Fed's losses are a fiscal issue. Who should have approved that positioning? Who should have approved that risk taking? And finally, we get around to what I think is an interesting issue, which is how is it accounted for? If one of Greg's member banks had losses of 5 times their capital, which we hope not, Greg, they'd be reporting on their books negative capital. And if they tried to take their losses and report them as an asset, whoever was the financial officer who signed that statement would be in very deep trouble indeed. But that's what our central bank has done. So who should approve a final governance question? Who should approve the accounting of the Federal Reserve, which is very dubious, to say the least. That's a very bad example. There are a lot of really fascinating questions around the finances of the Fed itself. Yeah, in my opinion, I think they did not expect, like I said, risk is the price you never thought you would have to pay. They knew they had this risk. They never thought and never forecast the level of the losses. The losses are, as of the latest weekly report, $226 billion of aggregate losses against a paid-in capital of $37 billion and retained earnings of $7 billion. So that's 5 times, they've lost 5 times their capital. And that's just the operating cash. These are real cash losses. As you all know, the mark-to-market loss of the Fed is $1 trillion. The total loss mark-to-market is 1.2 trillion. And this raises, in my mind, a whole host of really interesting questions. The most interesting of which are governance of the central bank questions.
Yeah.
Thank you.
I mean, this is outside my area of expertise, but to the extent that anyone is interested in this issue, I would recommend Bill Nelson is our chief economist, actually was former deputy director of monetary affairs at the Fed, and he has written a series of notes, articles about the Fed's choice to run an ample reserves floor system versus the traditional corridor system, and then the intangible and tangible costs of that. So if you are interested in this, I would very much recommend reading that. And it's also interesting, too, that he also talks about how the Bank of England now is actually sort of reversing course and is going back to more of a corridor system and, supplying reserves as needed. So, it's a fascinating topic. It's not one I can talk about intelligently, but Bill sure can. And I know Bill talks to Alex about this as well. So if you care, read up. Thanks.
He does, we do, and I fully agree with recommending Bill Nelson's work, which is very insightful and important.
Greg, the regulators are trying to improve their grade by moving towards counter-cyclical capital budgets, buffers. What is your view, and will it work?
Well, you can probably guess, given some of my earlier comments about macro-pru. So, I think the use of a counter-cyclical capital buffer presumes a series of things. First, as earlier, that you can spot the trouble coming. Second, that you will raise or lower capital, and I'll get back to that, promptly, such that it will have an effect in time. And then third, that the banks will react. That is, if you lower the buffer, they will start lending more. I think all of those things are not credible. And then there are even further problems. First, we don't really think they're going to spot the problem. Second, I think even the Fed's own design of the buffer, which they've commendably kept at 0, involves, I think, a 1-year lag. So it may actually be a pro-cyclical capital buffer. Third, and this is one of the great lessons of the post-crisis era, is buffers don't work. Capital buffers don't work. Liquidity buffers don't work. Banks don't treat them as buffers. They treat them as minimums. They do not want to telegraph to the market that they are in any way weak. So they don't treat them as buffers. So I seriously doubt if you lowered the buffer, you would see substantially more bank lending. Certainly in the liquidity area, that has been the case. There's also then the debate, and this is remarkable, the theory of the the CCYB is, again, if you see a crisis coming, you're going to lower bank capital requirements or lower the buffer to give them an incentive to keep lending to the economy. If you talk to some supervisors, including as of last week, some in Europe, they actually think, no, wait, it's the other way around. If we see a crisis coming, we want to raise bank capital requirements. Why would we lower bank capital requirements? So I think there's even sort of a schizophrenia within the regulatory community about why they're doing this. So it's an idea that kind of makes sense in theory, and it sounds good. It's got macro in it. That's always really good. But I don't think it's really going to play out very well. And it also involves, and that's the point Bill makes, is there's a great line from the Office, which he always quotes. It's, if you remember Dwight Schrute, he announces to, who's the John Krasinski character? Jim. He says, I can raise and lower my blood pressure at will. And Jim says, well, why would you raise your blood pressure? And Dwight says, so I can lower it. And so that's sort of the theory of the CCYB, is that we're going to have banks hold too much capital almost all of the time, with attendant consequences for economic growth and lending, so that at some point we can lower it. I think it would just be better to have the right level of capital all the time.
Before we turn to questions, I want to ask Gary and Elizabeth to talk a little bit about the biggest risks that they see out there. And in particular, I'd like to know where you put cryptocurrencies and stablecoins on that spectrum of risk. Gary, you want to start?
Yeah, so let me just start with stablecoins.
Get your mic so people can hear your.
Is it on?
Let's see. Yeah, it's on, isn't it?
So a stablecoin is a cryptocurrency with the feature that it's supposed to always trade at par, and you're able to go back and collect your dollar at any time. That's a little more complicated for the big guys. And this is the one area where there's a connection between crypto space and the real world. Like, we don't care about Bitcoin and all that. It's like trading beads. But stable coins, if I invest $100,000 in a stable coin, I buy it, the issuer has to buy assets worth $100,000 to back it up. So that if I go to ask for my money back, they'll have it, right? And most of the time they do have it. There's been some controversy over what they've invested in, but they do have it. Now, one thing we know is that the prices of, say, commercial paper change when the issuer issues more or less stable coins. And that's important because that's the one link so far between this crypto world and the real world. So if there were a run, for example, on the stable coin, and they had to sell all their assets, they'd be selling mostly commercial paper, which would be potentially a problem. So I don't know what you do about that. I mean, stable coins are transnational, and so nobody can really regulate them. Some of them have decided to become based in the U.S. so that they get the blessing of various things, but the big one, Tether, is not in the U.S.
You know, on Tether, if anybody's interested, there's a fabulous Bloomberg Business Report, investigative report on Tether, where they tried to find the assets that were supposedly backing the stablecoins. And it's an interesting article, foraging through investment banks and Wall Street trying to find it. And essentially they concluded, notwithstanding what Tether was saying, they couldn't find the assets that were backing those stablecoins on a continuous basis, which raises one issue in my mind. When nobody's watching, you can't verify that what's supposed to happen is actually happening. And that's as much human nature and history as anything else. Elizabeth, why don't you talk to this issue a little bit?
Yeah, sure. I think it's right to draw a differential between the stablecoin market and, the rest of the market. And I mean, the number one thing first to say is there needs to be some type of a regime that's established, ideally globally. Because, if there's something that we know through history, it's that the regulatory arbitrage that takes place around the world always ends in tears in some far corner of the world. In Europe, we've passed the markets and crypto assets regulations. It was passed in the parliament. And the idea of it is to put a single regime in place across Europe because, of course, you began to have pockets of jurisdictions that were starting to attract corners of the market and, having programs in place that did not have appropriately resourced or appropriately trained individuals with oversight responsibilities. So the idea of the MICA program that was put in place was to put rules of the road in place. It's been seen on the US side when you talk to the crypto market participants as something that's been very, very important. And the view from the US is Europe's putting in place a regime and it's open for business. And it's exactly what we need. We need rules for the road because there are bad actors. And then there are others that are trying to do this in an appropriate way. The technological acceleration that's taking place cannot be ignored. There is a market that is growing and having a global regime in place will help, I think, Tom, as you said, trying to trace these assets and trying to understand where they are, will help enormously in putting this together. I've got two major concerns about the growth in the market and the way that we've been approaching it so far. The first is, if you look at, those that are trying to benefit from this market, you have a segment of individual investors that are ill-equipped to withstand losses, that are trying to get on the gravy train and, make a lot of money really quick, make a quick buck. And they're very attracted by the asset valuations and the rising asset valuations, but they are not large players, and they are likely to be the ones that will be the most hurt, maybe apropos of the question before about the 401ks. So there's got to be something put in place that is appropriately, it puts an appropriate, transparent program in place so that individual investors, can be operating in a safer way. And the second is, I was banking superintendent during 9/11. For the life of me, I can't understand how it is that we will know that the financial system is free from bad actors when we've got the crypto market developing so much. How is it that we know what the source of wealth is? How is it that we know how funds are being moved? How is it that we know that the financial system isn't being used by terrorists that want to fly planes into our buildings? So, until we answer that question and have some oversight over it, I've got a very huge question mark in my mind about how this market gets appropriately controlled.
Elizabeth, if I could stick in a comment here, Tom and JP, your comment on the small investors make Stanton's law, which is risk migrates to the hands least competent to manage it, which I think is true in general. I have a question, if I could, about the European stablecoin system. Does it provide that the holders of the stable coins have a preferred or senior claim on the so-called reserve assets, or would they just be in there with any other creditor competing?
There isn't a diktat about that. What's really there is, that there is transparency about what the structure is, so that it's clear. There isn't a diktat that it has a senior claim.
So the assets could exist, but a bunch of other liabilities could also exist.
That's not incorrect. But remember, the other component, and Tom alluded to this, is that there is professional accounting that is put in place, and it's a requirement for licensing.
Okay, do we have some questions? See people rushing to the microphones again.
We do have a question here. We do have a question online, and it derived from Elizabeth's early talk, but nevertheless related to regulatory approach. So the question is from Kaba Kumar. And the question is, it seems in the EU, competition is an explicit design principle of most financial sector directives. In the US, however, it's mostly left to general antitrust law and only recently to the Consumer Financial Protection Bureau. Europe's regulatory architecture is more intentionally pro-competition in retail financial services. In your experience, to what extent does that fundamental difference impact regulatory approaches in the European Union versus United States?
I can say, that the competition it's a buzzword, right? At the moment, all across Europe, and I would say also all across the United States. The Draghi report that was recently issued is worth a read, and it has a very far-reaching scope in looking at how the EU is not competitive and what the numerous things are that they have to do to develop a competitive marketplace, starting with the development of a capital markets union, which does not exist. And that as an economy, the EU will not be internationally competitive and able to continue to finance innovation and to attract innovation if it doesn't set up a system of rules, laws, bankruptcy approaches and a fundamental single market for capital markets. They're calling it now the savings and investment market, because the idea is that it would be something that all European citizens could take part in. It doesn't exist. So competition is very fundamental and very much front of mind. Having said that, there's lots of discussion across Europe and especially in the UK at the moment about whether competition should be something that is a cornerstone of a regulatory program. For me, that's a mistake. It's not the role of a supervisor to foster competition. It's antithetical to what the role of a supervisor is meant to be, which is to be able to act in the interest of the overall market, not for the benefit of particular market participants. Free markets are for market participants to achieve their own competitiveness. So it's not a tenet at the moment of a regulatory framework in Europe. Having said that, one major part of the Draghi report, I think, also focuses on this rules-based environment that's been developed. And frankly speaking, we have it here in the US as well, 5,000 pages of regulation last year alone. Institutions fall over from the mere weight of that. That itself is a risk. And it's pointed out that the competitiveness of the European economy is adversely affected by the numerous rules that are in place. Simplification of the rules is something that can and should be done. As I said before, at least with the banking union, which was born 10 years ago, there was a need for a lot of rules so that there was an understanding and trust that could be developed across jurisdictions. But 10 years in, it's possible to simplify those rules and not codify every single component. And if you don't mind, I feel the need to, it's not in response to this question, but, I've been working the last 5 years with incredibly talented men and women at the ECB, but also internationally. A big part of my mandate was international cooperation. And so I've spent a lot of time with the colleagues at the federal supervisors. They are underpaid. They are underappreciated. I feel really a need to support very much the work that they're doing. We need to make it easier for them to do their jobs. But I would start with making sure that, it's a fair game and a fair fight between the industry and what we're equipping the supervisors with. Smart supervisors are and well-paid supervisors that do a good job makes for a much more efficient market.
Okay, we've got a question there.
So transparency is clearly the issue, and avoiding these catastrophes, and the identification of the parties involved, the collateralizing or the financial instruments and the collateral resources. Treasury is going for LEI to try to disambiguate the legal entities that are involved. People like Bloomberg has set up financial instrument global identifier systems to try to disambiguate the financial instruments that are, involved. As we're moving on to blockchain, there's going to be thousands and thousands of systems that are going to be managing the assets that are collateralizing these instruments. I'm wondering if there's any work like LEI or FIGI that's starting to span the ecosystem in the digital asset world to start disambiguating assets and asset classes and collateral instruments.
That brings back a memory. I think 10 to 15 years ago at JP Morgan, I had a woman work for me who worked full-time on the LEI committee. Did it ever even happen? Good for her. That's all I have to say.
Gary, do you want to?
No, there's nothing like that. And there hasn't been a lot of serious discussion about it either. And there's two reasons. One reason is that, again, it's this transnational myriad mess of stuff. And the second reason is, identified earlier, is you can't find out what the assets are of these companies. We're a pretty long way from that.
Thank you. Great panel. I'm transfixed by the question about if you were starting over, what would the system look like? And to the gentleman who suggested that the Fed should be subjected to a series of lectures, but would it not be a friendly amendment to say, really, it should be directed to the political actors? And specifically, I want to place it in this context. All of us who study financial crises or live through them know they end with the Fed bailing the system out. But there is a theory that given the current state of the federal budget or of the federal debt, we're simply not going to be able to do it next time at anything kind of an acceptable cost to the currency. So could we not have a block, and I'm thinking of the system as it stands right now, and something along the lines of the way threats in intelligence and defense are provided, of an effort to absolutely scare the bejesus out of these people and understand what they're actually doing, just with the simple backdrop of this endless growth of entitlements and interest, and how that could turn out. I realize this is a field from the great expertise in the room about regulation, but all of it has to work against, it's the leverage and the vulnerabilities in the system that really determine how deep the crisis is going to be.
There is one very interesting idea that's floating around in the central banker world about, in a sense, reforming the Fed, and that's called prepositioning. So it's the first reasonable idea that's been proposed to change the discount window. So what happens is banks have to put their assets, or some amount of assets, with the Fed. It's called prepositioning. And they can get those assets back if they want, or they can leave them there. And the idea is that if something were to happen, it'd be very easy to move your assets straight to the discount window, which is something that we saw didn't happen with SVB, for example. So there are large banks who already pre-position about 30 to 40% of their assets. And you can take it to the extreme and see why it would get rid of runs, which is suppose all their assets were pre-positioned. Then no matter what happened, they could get the money quickly. So this is not an idea that people can't figure out like what the number should be if we required banks to pre-position a certain fraction of their assets. But you can imagine the difference between this, say, and capital requirements, right? So we'll see what happens with that.
Let me make a suggestion. Let's just cut this off because we've got to get to the donuts. And the faculty will be here. All of the faculty that's sitting out there and here will be here for that. You can wrestle them to the ground and ask questions there. So let's take a quick break. We'll come back at 10:40. So that'll give you some time to hobnob with the speakers and the faculty and pull them aside and ask your questions. I'm sorry, we got to keep going. But Alex, I'm going to leave you with one thought. This is the first panel of faculty members I've ever sat on that has 3 philosophy majors: Alex, myself, and Randy Quarles this afternoon. So I don't know what that means, Alex, but you can put it on your resume.